Hey everybody, welcome to another episode of What the FICC. What the FICC, man? I am Spencer Israel, joined by Ian Cully, head of fixed income currencies and commodities at All Star Charts. Mr. Cully, how's your Friday going?
Oh, it's beautiful. How about yourself, Spencer?
I wouldn't say beautiful. It's a little bit cold and rainy here, but hey, Fridays are generally a good day, so I'm still in a good mood. Mr. Cully, we've been talking a lot on the last few shows for the past few weeks about commodities because there's a lot to talk about there. We're not going to do that today. We're going to talk about bonds and rates and the relationships with the stock market because we know that the relationship between the bond market and the stock market is incredibly important.
Mhm.
Um, the correlation, generally speaking, they are correlated when inflation is high. They are not correlated when inflation is low. And we know that the movement in the bond market can oftentimes dictate the movement in the stock market, but there are some myths that need to be busted. So, you ready?
I am ready.
Okay. Uh, Talk to us about this myth that um that higher rates are automatically bad for stocks.
Yeah, I think we can just look back to the first half of this year and look at, the 10-year yield was up around 4%, bounced around between 3.5% and 4%. And the NASDAQ 100, an index that is historically very sensitive to rising rates, at its best first half in its history. So
That was
it's
fun.
not,
It was a fun first half. Let me tell you, I enjoyed it.
yeah, it was a fun first half. Now the
Yeah.
party ended. The party ended when rates broke out of its range and began to rip higher. And that accelerated rise in rates is really what has caused the selling pressure or increased volatility across other asset classes, mainly stocks. And that's
So the
really
nat
what it's about. It's about the increased volatility.
so the nat yeah, okay. So I was gonna say the natural conclusion of this chart is that when with bond yields spike basically going parabolic, right? And you see that and you see stock market going down, the natural conclusion is that higher yields bad for stocks. And your point is that it's not really about the level of the yield. It's about the volatility of the movement. It's about the quickness of the movement, right?
Absolutely.
It's not so much about yields being at a certain level. It's just how quickly they've gotten there. That's why the stock market is weak right now.
Exactly. And that's what this chart really breaks down here. This is the S&P 500 and the bright blue line overlaid with the bond market volatility index, the move. And I've inverted that line. And so to make the correlation appear positive. But in fact, when this inverted line, the move is catching lower, the bond market volatility is increasing. You can see that does not bode well for the S&P 500. Now, you got to think about how big the bond market is. It's the largest market in the world. Over
Yeah.
$120 trillion. So when the money is moving around, slushing around in the bond market at I would say accelerated rate, but when there's just a lot of volatility, that spills over into other asset classes, including commodities. We've seen a lot of selling pressure in the
Yeah.
commodity space. We talked about that on Wednesday. And so we're seeing the same in stocks, and it makes sense.
So is it a general conclusion that bond market volatility is not healthy, right? Stock market volatility is um maybe healthier for the stock market than bond market volatility is for the bond market. Is that fair to say?
Yes,
Yeah.
absolutely.
Just
Absolutely. Bond market volatility
or
is
maybe
not
just
good, not good for anybody.
yeah. Yeah, maybe just wait. Not even a question of healthy or not. Just way less normal. This is not normal.
No, bonds are supposed to be boring. They're
That's right.
supposed to be boring. And
That's what I was
look,
told.
yeah, and look at the 30-year T-bonds. That is not boring. I mean, it's falling apart, breaking a multi-decade up trend line here. You know, that was what, last year? And it's just continuing to resolve lower. This isn't the kind of environment that bonds do well in, or stocks. And I kind of wanted to get to that today, and also just look at stocks versus bonds, that relationship, and what it could be telling us might lie ahead in the future, in the coming years.
All right, let's go.
Here we have stocks versus bonds. You know, Chart Summit, Ari Wald had an excellent presentation, and I really liked how he pointed out small caps versus large caps. And, you know, he reminded everyone that it was a ratio chart. It is a ratio chart, and how ratio charts work in terms of analyzing them. You know, their relationship, right? So just because small caps might be underperforming large caps, he wanted to make sure that the viewers weren't conflating that with a lack of participation, right? So this stock and bond ratio, as it increases, as it widens, or as stocks continue to outperform bonds, both stocks and bonds could be doing very well, or both stocks and bonds could be rolling over. That's kind of what we're dealing with today. And here we have stocks versus bonds, just absolutely ripping over the past year and a half, hitting new all-time highs.
Wait, you know what's wild? If you go back to that first slide, what's wild to me about it is if you cut the chart off at like 2022, I'm just going to ignore the last year or whatever. This chart looks like SPY, you know?
Yes.
It looks like SPY. And that just goes to show you how slow and boring TLT has been.
That's a great observation, Spencer.
And because you can look at SPY relative to SPY, which is the same thing, right? Or look at SPY relative to TLT. They're not that dissimilar. SPY over 1 is not that dissimilar to SPY over TLT.
Right. And here, you know, seeing the TLT is really driving this right now. The denominator in this ratio is driving this line higher, and we see it right here with the bonds. Look at that.
Yep. Oh man.
Yeah. But so we've been talking about this, you know, for over, you know, a year now. I mean, especially last year when the 60/40 portfolio just got absolutely decimated.
I thought that was the end. I thought the 60/40 portfolio, first off, does anybody actually have one of those? Second off, secondly, I was told that last year was the death of the 60/40.
Yeah.
Yeah.
Well, I want to share a chart that kind of it highlights why the 60/40 portfolio, has worked so well for so long, but that's starting to change. Here in the lower pane, we have a 40-week correlation, rolling correlation between the S&P 500, which is that top line, and a 30-year T-bond, long-term treasuries, the lower black line. You can see it's usually negative. It's usually negative. And I just highlighted the peaks in the 30-year bond, coinciding with many of the troughs in the S&P 500. Now, of course, there have been periods over the past few decades where there have, you know, they've both moved together. Here, you know, in 2014, both stocks and bonds rallied in tandem. You know, we saw the same thing in leading up into the 2020 peak. But now bonds are starting to roll over, and they're continuing to roll over. And we're starting to see a positive correlation, a positive relationship between stocks and bonds kind of take hold. And that's what we're dealing with. That's the problem with the 60-40 portfolio. And when stocks are rolling over, bonds aren't that safety net, right? US Treasuries aren't that risk-free asset that provides some stability to your portfolio.
Well, they usually are, but they're not when rates are going parabolic like they are right now.
Absolutely.
Right. So
Absolutely.
this
And it
time,
really,
this time is different.
and I think it really all comes down to the dollar and rates, and that strong relationship. Here we have the U.S. 10-year yield and the U.S. dollar index. I've shared this chart numerous times. I think it's very interesting. This is really what's driving the current environment that we're dealing with. What I want to point out here is the 21-day rolling correlation in the lower pane. And and what I want to highlight is that the negative correlation between these two markets, the dollar and the 10-year yield, that floor for the negative correlation has been rising over the past couple years.
So you're saying you're saying even in with the rare instances, or at least recently, relatively rare instances where the dollar and 10-year yield are inversely correlated, that inverse correlation is getting smaller and smaller and smaller.
Exactly. It's been getting smaller and smaller and smaller, and it's almost non-existent since the spring of 2022 when the Federal Reserve began to hike interest rates. So this really speaks to this shift in the market, potential shift in a rising rate regime. And it's much like a bearish to bullish reversal in momentum, right? Much like what we see when we're looking at the 14-day RSI and we're looking at the dollar or cocoa or sugar or cattle, whatever it might be. Apple. Here we have the bullish regime turning into the transitioning into a bearish regime, and now back into a bullish regime for the dollar. Dollar's ripping. Everybody knows that. Everybody knows the dollar's going. Everybody knows the rates are running with it. But could we see a similar reversal in terms of the correlation with stocks and bonds? I think we might. I think it's possible. I think it's possible. And if we go back to the 80s, late 70s, early 80s, all the way up into the mid 90s, stocks and bonds, based on this 40-week rolling correlation, tended towards a positive correlation, not a negative correlation. This negative correlation is something that we've become accustomed to over the past couple decades. Now that we're moving into a potential rising rate regime, which I think we are, I think is pretty evident. Maybe,
I mean, we're in it.
Maybe, perhaps we move back into a period over the next, 5-10 years, maybe longer, where stocks and bonds actually start to trade together again and have a positive correlation, not a negative correlation.
I have a question for you.
Yes.
Does anybody really understand why bond yields are ripping higher right now? Does anyone know?
Well, I think the market is they're starting to price in future rate hikes,
or simply higher rates for a longer time. So
Absolutely.
Maybe just fewer no rate cuts for the foreseeable future.
Yes. And that's the thing, though. When we start looking out, using the federal fund futures to using it to try to figure out the probability of what the market's pricing in, December of next year, I think it's a little, I don't know. I'm not so crazy about that data. But the fact is that the federal fund futures are continuing to push back the probability of a rate cut further and further down the road.
Right. Right. So the market now adjusting to the fact that, hey, interest rates are elevated. What's the federal funds rate now? 5%. I don't even know, honestly.
5.25.
5.25, and maybe it stays there longer than we thought. Maybe we just went from what 0 to 5 in the span of what 2 years. Maybe we don't go back down to 2% in 2 years. Maybe it takes us 10 years to get down to 2%, right?
Yeah.
So yeah, okay. Not a
I
fun
think
thought.
it's also interesting that the last, during the, the 80s, of course, coming out of a commodity super cycle, those markets were extremely volatile. And we've seen a lot of volatility over the past couple of years. And just looking at the S&P 500 from 1980 to the mid 90s, I mean, look at these big corrections.
I mean, it looks to me that corrections, well, we know corrections are normal. So
They
all
are
this,
they are normal. They
yeah,
are normal.
yeah.
But I mean, if we're gonna go by, the whole bear market is a 20% correction. We had numerous bear markets over the course.
I mean, we're still in a bull market, Ian. I mean, if you go off just year to date, right? Performance.
Right. I mean, we'll look at what was it? Black Monday.
Right. That's a good example, actually.
Right.
Because if you look on the chart there, that's the 33% correction right there. But I mean, you look what happened 2 years. Fast forward 2 years, and you're back all-time highs, right? So, and that was without any sort of government intervention. That was just the market doing what it does.
That's right.
So
that's right.
There was no fire hose of money from the Fed in '87. There was just people buying with two hands. So, anyway, all right. What other charts we got?
So I think I just want to I think this is really interesting. When I look at the 40-week rolling correlation, this is something that catches my eye. I start thinking, hey, what if we're entering into a new rising rate regime, and this is what it's going to look like for the next 10 years or longer. I think it's interesting. It's something to keep in mind. Something to keep in mind that we could be entering a period where stocks and bonds trade in the same direction more often than not.
Well, aren't they usually? They are usually correlated when inflation is high. The difference is that inflation has been flattening, right? It hasn't been coming down, but it's been flattening. Right. So is the implication there that with inflation not going up at the rate that it was before, that would mean that stocks and bonds that the relationship would diverge again? You're saying not so fast.
Yeah, I'm saying not so fast. I'm in the camp that inflation is sticky. It's not going anywhere. Rates are continuing to rise, and they could rise for the foreseeable future. But whether or not stocks and bonds are positively correlated or negatively correlated, I mean, that's not the most important or the biggest concern.
So what's the question?
To the stock market, it's more about bond market volatility. I mean, this is to get back to this chart. This is really what it's all about. Stocks like it, commodities even like it. When the bond market is just at a nice, slow, easy pace, 5.25. I don't think 5.25 for the 10-year yield is really that big of a deal. I don't think it's really, in terms of the actual market, stock market. I don't know about the economy. I don't think it's that big of a deal. Whether we're talking about 5.25 or we're talking about 4.25 or 3.75.
But it is a big deal when those
But
things
it
are
is a
are
big deal when the
yeah,
10 years ripping higher like this. Yeah,
yeah,
absolutely. And the
yeah,
bond market volatility is spiking. That's
yeah,
that's that's the problem.
yeah. All right. Do we have anything else, or is that a good place for us to end it?
I think it's a good place to end for it's Friday.
Yeah, yeah. Bottom line here is that we're all just basically waiting for bond yields to stop ripping higher, and for the bond market to stop for the prices on these bonds to at least stop going down, and that would coincide with one. I don't know. It would coincide with stability in the stock market. Would it coincide with the dollar coming down? Probably, right?
I would think so. Absolutely.
I would assume so.
I mean, we're
I'm
starting to see a little bit of that today.
I'm
Silver's
pulling up the
starting to
dollar.
catch higher. Bonds are starting to catch higher. Dollar's pulling back a little bit.
Yeah, I'm pulling up the dollar index right now. Yeah, interesting. All right. Well,
We'll see how we go into the close.
yeah, always interesting, especially on days like today when you get a bigger or more important, I guess, economic data point that just it's not about the number, it's about the interpretation of the number.
Right.
And so right now, I mean, actually stocks are up today.
Right. And that
They
was the thing.
really
There were multiple
yeah,
numbers, and they
yeah,
were mixed. So it's like, so which one is the market going to weigh more heavily?
yeah.
That's
Very
why I don't like trading this economic data. I just like,
It's so
looking at
difficult.
yeah.
It's so
I mean, I
difficult.
love the conversation. I loved you and Neto getting into it today on the morning show. That was great. I just don't know
Well, I'm just becoming very what's the word, jaded. I'm becoming very jaded about um economic data, about just the numbers themselves, because they're getting, I feel like revisions are happening more. Maybe this is just, maybe I'm wrong, maybe they always happened, but I feel like just these revisions are getting bigger and bigger and bigger after the fact. I like what actually our guest today on the morning show, Anne Marie Band, said this a
Mhm.
long time ago. She said, we care about the numbers because they're there, right? Because they're there. It's not so much about, you know, because they're tradable events, and that's what they are,
Yes.
because they're there. So anyway, that's why I more closely watch the reaction than I do the numbers themselves. No, you did not miss the discussion about natty gas breakout, Jeff. We did not talk about natty gas or commodities at all today. Actually,
We didn't.
we would do that. Knowing us, well, we can't go more than a day or two without doing commodities on this show, because it's so interesting right now. So maybe we'll do that next week. As a
Well,
reminder,
I highlight
yeah.
natty gas in today's commodity post, so it should be out later this afternoon.
There you go. As a reminder, next Friday show, we're doing a mailbag edition. We're only going to do just questions that you guys have about anything. So, because we don't usually do a lot of Q&A on this show. So if you have a question about anything related to bonds, commodities, Forex, futures, whatever, email us questions. It's at stockmarketmedia.com. It is on the screen. It's on the bottom there. And we will compile them and we will answer those questions. Or I mean, I won't, but Ian will answer those questions on next Friday's show. So stay tuned for that. One hole. Does that mean we need to disregard everything we quote unquote know in the last 20 years because it's not the same environment? Kind of. As much as you hate to say the words, this time it's different. Isn't it different this time? Isn't it
Well, I mean,
always different?
it depends on what we're looking at. If we're looking at back at the 80s, late 70s, 80s, I mean, there are similarities. If you look at the past decade, the prior decade, it's definitely, the environment is changing. So
Yeah.
instead of just saying, hey, there isn't any valuable information from the past 10 years, I think it's better to just look or at least understand that we are in a new cycle and it could look very different from what we've been accustomed to, right? That, we've been talking about this for the past couple of years, commodities, looking for areas of the commodity space to invest in and trade.
Yeah.
Emerging markets potentially outperforming, or just international stocks in general potentially outperforming U.S. stocks.
Maybe. One whole, I don't know how old you are. I am in my early 30s, and I am having to sort of unlearn everything that I've learned, because I grew up in an environment where the US was the only game in town, as particularly technology was the only game in town, really. And I've never even thought about owning commodities or any kind of commodity, gold, energy, whatever. It doesn't matter. They've been awful. Bonds, forget about it, right? Why? And so I'm having to now, in the last year or so, really, unlearn all of my, or change all of my assumptions, because we are all sort of influenced by the environments that we grow up in, right? And I have grown up in an environment where interest rates were at zero or near zero. If you wanted alpha, if you wanted yield, you had to go to the stock market, particularly technology stocks. And it was all about growth. And it's not that way. It's not that way at the moment. And that's okay, because it hasn't been that way before. Cycles change, we know that, but it's been a crash course in living that, right? It's one thing to know that cycles change. It's quite another thing to live through it. And we are living through it now. And if you are someone that came of age in the last 12 years, 13 years, you have to change some assumptions you have, and that's okay.
Well, hey, right? We all have those anchoring biases too, so we're all right there with you, Spencer.
Yeah.
And it's going to be messy. I mean, we're in the early stages of a potential new regime, and it's still very messy out there.
Yep. All right. Biggest takeaway today: nobody actually has a 60-40 portfolio under the age of 75, and if you do, I don't believe you. That'll be our show today. Thanks to everyone in the chat for hanging out. We'll be back on Wednesday, 11:30 a.m. Eastern time, same place. If you have any questions about just things you want us to answer, or just in general, email us at the email on the screen. Follow Ian and I on Twitter. Our handles are on the screen and in the chat. Check out Ian's blog. The link to that is in the description. And if you want full access to Ian's research, all his charts, if you even want to access to Ian's email, subscribe to All Star Charts Premium. The link to that is in the description as well. And we're done. It is noon. Time to go. It's Friday. Have a great weekend. We'll see you guys next week.
Thanks for watching, everybody.